Hello, and welcome back to the podcast. Thank you very much for being here. I appreciate it. And thanks for binging. I got, it's like, Tuesday today as I record this, and I've already gotten 2 emails about you guys all binging, listening to me. And I had a meeting today, and the guy's like, man, I could just listen to you all day. I just love that German passion. Oh, thanks, you guys. At least somebody likes to listen to me. Good thing you're not family, or you'd be like, does a lady ever shut up? Okay, today we are going to talk about practical implementation of how to use it. Because for whatever reason, I have gotten this question over and over and over in meetings. But guess what? I have never actually addressed it on the podcast, I don't think. And I get the question a lot. So here we go. Practical implementation. What happens, Mary Jo, when I borrow money from the policy? Where does it go? Does the life insurance company give me a checkbook? How do I manage that loan? All those good things. Number 1, if you are going to borrow money from the policy or against the policy, let me correct my own language. If we're going to borrow money against the policy, that money is going to be ACH'd into your bank account. You're going to need a checking account. As much as I would love to say, oh, this is 100% without the bank, and we never need fractional reserve banking again, that is not possible. I'm sorry. Even if they send you a check and they don't ACH the money to your account, even if they send you a check, guess what? You have to cash the check. So we're going to need a bank. The money will get ACH'd. For those of you that don't understand that, the money will get transferred to your bank account of choice. Okay? Once it's there, then we can use it to buy equipment, use it for operating, use it for whatever it is that we're going to use it for. Then what happens when you sell grain or you sell cattle or you sell commodities of whatever kind that you're selling? Then you will sell your commodity and that deposit goes back into that same checking account, right? Then you will write a check to the insurance company to pay back that loan, or you will go online and have them ACH it from your bank account over to your policy loan for a payment. That is the practical piece that so many of you miss, and I 100% understand why, because I missed it too. I'm like, okay, if we're supposed to get rid of the banks, how do we do that without a bank account? You can't. So we need that bank account. Now, let's talk about operating versus an equipment note. So let's say that you've borrowed $50,000 for operating. But that $50,000 is going to go from your policy into your bank account. Okay? You are going to buy seed, fertilizer, chemical, feed, hay, pay vet bills, whatever. That money is going to get written out of your bank account to buy seed, for example. Now, when you sell grain and that goes back into that bank account, you might turn around at the end of the year and you might pre-buy. So why make a payment back to the life insurance company just to turn around in 10 days and borrow that money again to pre-buy? Just use the banking account as your line of credit. So essentially, you've borrowed money from your policy one time, and we buy things and pay them back into checking. When we make a profit farming, then we are going to pay any of that profit back to the policy as a loan repayment, and we are going to pay interest only. So think about it as your line of credit at the bank that you're just going to pay interest only on. Okay. It is not, that is okay to do that. Now, let's say that you've borrowed $50,000 for a piece of equipment and you buy this piece of equipment. Well, obviously, when you buy a piece of equipment, you make yearly payments back for several years, right? So do the same thing into your policy and make those payments back for several years. It's if you're using a line of credit and we're borrowing and paying and borrowing and paying, it's more of a nuisance to be paying it to the company, having them process a loan, paying it to the company, having them process a loan. If you talk to insurance companies, the most expensive part of the whole insurance process is loan paperwork. Because they're so manual, life insurance companies are old. They don't do stuff online. Like the fact that we can even pay a loan online and pay our premium online is leaps and bounds where we were 10 years ago. So they're still very old. They are not banks, you guys. They are not a bank. We use them as a bank, but that is not what they are. So it's a very manual, expensive process. This is your business and my business. We all own part of this bank now. So do we really want to have our company having these massive amount of expenses when it's not necessary? I don't. So if I'm going to use it as a revolving line, I'm just going to move it into a checking account and use that checking account. When I make profit, I will then use that to start paying that back. If I don't make profit, then I will just pay interest only. Okay? It's totally okay to do that, but we are going to need a checking account. The other thing that people ask me a lot is what happens when I take a loan? How do I know how to pay that back? Because guess what? The insurance company does not care. Now, that is awesome on one hand and not so good on the other hand, because if we are not honest bankers, that's not the best option for us. Or if we're not organized people, that's not the best option for us. So if you take a loan and you use it for a piece of equipment, well, how am I going to pay it back? Well, I don't know. How do you want to pay it back? You know, we don't typically get to choose that. So now we're in control and we don't even know what to do. So run an amortization schedule. You can go online and you can find free amortization schedules anywhere. I believe Farm Credit is the best for having a amortization software that you can pay yearly. Most free online amortizations will not let you pay yearly because most people pay monthly. So I think Farm Credit has the best one. If you are clients, you can call and we can possibly do that for you. Okay? If you're not a client, don't be calling me for an amortization schedule. It ain't going to happen. But you get to decide because you bought a piece of equipment. Are you going to have that piece of equipment for 10 years? Are you going to have that piece of equipment for 2 or 3 years? However long you're going to have it is how long your amortization should be. So if you're going to have it for 5 years, then great, pay yourself back over 5 years. If you're going to have it for 10 years, pay yourself back over 10 years. If you plan to trade that piece of equipment every 2 years, then make sure it's paid for in 2 years. Because otherwise, you could go upside down very quickly if your trade is not worth more. Now, if you're trading with today's world the way it is as I'm recording, you're never going to be upside down. But let's say that you buy cattle and you want to, have them paid off in 10 years, then pay them off in 10 years. If you've got, which paying them off in 10 years would be silly because that cow is probably going to be dead or not calving for you in 10 years. So make it 5 years, make it 7 years. If you're buying older cattle, then maybe you want those paid off in 2 to 3 years, because you might be calling cows every 2 to 3 years. Make sure they are paid off. But you have 100% control of that. The next question is, well, Mary Jo, how do I put that in my bookkeeping? How do I do that? The same way you would if it was a bank loan. If you take a loan from a bank, you put it in your accounting as accounts payable, right? It's an expense in there that you have to pay every year. This is the exact same thing. This is an expense that you have to pay every single year. The banker in this scenario just changed. Instead of you answering to the banker in town, you're answering to yourself. Again, number one reason that infinite banking is going to fail is because of you. You didn't treat it like a bank. So put it in your system that you have to make this loan payment to the life insurance company every single year. And just as you would not miss a bank payment, don't be missing a payment on your tractor or cattle so you can go on vacation. No, it doesn't work that way, you guys. If you can go on vacation after the payment, fantastic. But don't be missing a payment just to go on vacation. Be honest. But you have to, or give it to your bookkeeper if you have a bookkeeper. Give it to your accountant if your accountant is keeping those books for you. I don't care how it's done. When you run your amortization schedule, you throw that in with your other loans. Yes, you have a loan. Now, it's kind of easier for me to say that because the only loans I pretty much have are in my policies. But they're still there, right? I still know that I have to make a payment on them. Some of them I'm not making a payment on. Like I paid one off the other day, took another one. That one was for land that we purchased. We're going to do short-term rental on that. I don't have anybody staying in that property right now because we're having to do a little rehab on it. Well, guess what? I'm not making a payment until I have the rental income coming in. But once that rental income comes in, that's just all of that money is going to go back into that policy. I'm not going to stick any more money into that property with the income off of it to make it better until I have some more money built up. Okay? I want some bit of a reserve. Trying to think of what other questions that I would get normally. Those are kind of the big ones about how to practically do it, because it all looks very easy in the book, but I leave out the piece of how to handle the money. And the bookkeeper is typically the one that has those questions because this is so out of the norm. We just can't even fathom how we would do that. And we should know how to do that, because if we're borrowing money from our savings account, we should be paying savings back. If we're using money from a 401k or IRA that we had, and then we decided we're going to cancel that thing and stick it in the farm, guess what? The farm better be paying you back for the retirement money that you used. I don't care if it's policy money, money in savings, investment money. It was all money you put into the operation that needs to come back to you. Because without it, you would have had to go to the bank or you would have had to go to a credit card. I think that's it. I can't think of any other common questions that we get about the practicality of that. Some people might, here's another one. Some people might question, well, should I have them deposit that money in my checking account or my savings account? It doesn't matter. The life insurance company doesn't matter. Taxes and accounting may matter. What is the easiest for your accounting system? If you're using it out of a checking account, then put it in that checking account. Some people actually set up segregated accounts, that the life insurance money goes into that account and that account lends it to another account. And then when you pay it back, it goes to the segregated account and then it goes to the life insurance company. Some people have to do that. I have many friends that do it that way. That is way too much moving of money for me. My brain is not that complicated. I don't need all those extra moving parts to make this work for me. I need to keep it very simple and very straightforward. I know why they're doing it that way, but it's just not how my brain works. I do not make my loan payments monthly back to myself because I don't know how much money I'm making monthly, right? It's too many moving parts for me. I make big lump sum payments. That's how I do it. Now, if I were to buy a vehicle or something like that, then yes, I would make those payments automatically come out of my account and go to the life insurance company. Because yes, you can set up automatic payments, or you can just write a check, or you can just go online to make a loan payment. Some people like the automatic payments because that's how they're used to paying things. I don't buy cars through my policy at this point. I will go to the bank and get a 2% loan because we have an awesome bank that does that here. But when I'm buying land or I'm renovating a condo or a rental or something like that, I'm going to pay that back over time, and I'm just going to randomly do that because that's what works for me. You can make whatever you want work for you. It's yours. You're the banker. You get to answer those questions. You get to decide how honest you want to be. So that's the practical moving of everything. I hope that helped and that made sense, because so many people have that question, and clearly I have just never thought to answer it before. So let me know if you guys have other questions, other comments, other concerns. You can email me, maryjo@withoutthebank.com. If you have not gotten the book Farming Without the Bank yet, grab the book, go to farmingwithoutthebank.com, get the book, read it, schedule your appointment. I am happy to help you set up your policy, help you with strategies, all that good stuff. So let me know if there's anything that I can help you with. Otherwise, you guys go grab the book and have a fantastic rest of your day.